So, do you also have insurance options for those taking money from you? Because you will have to also see you are safe. Because there is insurance. But even if the someone who's borrowing from you doesn't have to pay, you can claim the insurance. Do you have something like that?
Yes, there is. It's a wonderful question that you're asking. For unsecured products, there are two types of insurance. Right? The first one is the death and disability insurance. This one, where if the borrower has an issue in terms of death or disability, that the insurance company will pay the It's a standard product which is in the market only. But there's another product called credit default insurance. Now, this product covers the other aspects of risk. Let's say there's a borrower, he faces some challenge and he's not able to make the payment, right? And there's a process. So these two products, but that said, actually, these two products are standard products in the market.
Okay.
We have to work with the insurance companies to structure a product which suits our requirement. Because every fintech operates in a different zone, right? And they have a different product altogether. So what fintechs does today is they work with the insurance companies to structure a product which fits their requirement. That's how it operates. But there are insurance possibilities.
So it's not a compulsion, is it?
There's no mandate as such.
Okay.
You have to take a policy.
But if you mandate an insurance on someone borrowing money from you, fintechs are pretty safe then, because there is no risk that you have. You're just taking money here, giving it to them. If they don't give you back, you just have to claim the insurance.
Right.
If I'm right.
See that doesn't work like that.
Okay.
Because in that case, you are as a lender, you are passing your risk to the insurance company.
Correct.
And the insurance company will not agree to this.
Right.
The whole idea here is when you lend, you take certain percentage of risk.
Right.
You are aware of it. You plan for it. You in the year beginning, you budget to it. You say this much money is something which I may, right? It happens. Right? Any external events can impact lending business.
Okay.
I'm not talking about Quid, but in general. So that you budget for it. You say this much money I may lose when I lend. But the idea is when you build a book, you accommodate all these factors and then still say this is my plan and exactly this much is the margin that I would like to make. It's a model, it's a financial model which you have to work on. And then decide what is based on your risk appetite. Each lender has a risk appetite. He would go up till his risk appetite. Depending on the product, depending on the if the product is within the regulated framework, he decides how much risk I want to take in this business for this particular year. Based on that, they plan.
Okay. What about processing fees? Because is that also there?
Yes, we charge processing fee.
How much is the processing fees?
It depends, as I said. There's an anchor. We work with him. We ask him, what is the size of his.
On an average,
it depends. It can be as low as 0.2%. It can be as high as 0.5%. It depends. It varies anchor to anchor. We do not have a standard processing fee charged to all the anchors. Because there's a lot of tech cost which is involved. Like when I go to an anchor or a borrower, because there's a lot of tech costs that we have to take. There's a legal cost too. To cover this, we have certain fee which we charge one time as person.
And what is the range of the rate of interest that you charge on the
Yes, see, I'll give you the range.
Yes.
It can be as low as 10-12%. And at times it can be as high as 15-16%.
Okay.
It again depends, because when we partner with Anchor and when we analyze the borrowers, we decide. There's a concept called risk-based pricing.
Okay.
We understand the risk levels. What are the probability that this borrower may not pay us back.
Got it.
So the pricing of the loan product is always done based on the riskiness of the customer.
Got it.
Higher the risk, higher the interest rates. That has been the industry standard. But yeah, this is the range at which we operate.
So do banks also offer loans without a collateral? Is that also there?
It's there.
So that is there. Why would there be a necessity for a fintech to fill the gap that the banks have?
Good. So the reason why fintechs have emerged in India is that they focus on the space where banks cannot actually focus and scale.
Okay.
So for any business for that matter, it has its own DNA, right? They work, they strengthen that DNA as and when they grow.
Okay.
But when they do this, they may not be able to touch all the product gaps that are there in the market.
But if the system is so large and there are so many banks in the country, wouldn't it be pretty easy because all of them are nationalized players, big banks? Even if there is a dearth of, you can't expand to everything. I think with the manpower that they have, can't they also get into all these KYCs?
They can see the banks in India have a different mandate.
Mm-hmm.
Right? If you see public sector banks,
Mm-hmm.
they have a clear mandate. Right? They have to focus on certain social aspects of it.
Mm-hmm.
They do good business, but still they have a mandate from government of India.
Correct.
If you look at private banks, they prefer doing corporate banking. They prefer doing CASA-based accounts, like current account, savings account.
Mm-hmm.
Each bank as a business has its own core strength. They focus on that.
Mm-hmm.
But the moment when it comes to supply chain finance, right, for banks to get into this, right, they have to build a product which is fully customized to the market.
Okay, got it.
That they may not be able to only do it. I'm not saying they cannot do it,
Right.
but they have stake somewhere else. They have invested heavily somewhere else, and they focus on where they have invested.
Okay.
So this is the gap which we found, that
Okay.
banks may not suddenly jump into this because for them scale matters. Right?
Correct.
Each ticket size matters. They have a different regulatory framework. The banks have a higher, very rigid regulatory framework. But NBFCs are meant for certain things.
Okay.
So this is the market gap which we identified based on our research, and we said, okay, this is the space where we want to operate.
Got it.
The good part is now there is a very strong collaboration in India between banks and fintechs. Banks are, whenever I talk to any bankers, right, they are more than happy to join hands with us and build books even in this segment. So there's a tech base which we have built, which they do not want to suddenly invest in,
Okay.
right? And what they say is, okay, if you have already built the tech, if you have already built the ecosystem, we will partner with you, we will lend through you. So, end of the day, the advantage is the tech that we have built, the ecosystem that we have created, on which even banks can lend. And that exactly is what Quid has done.